Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today I want to go over cost curves. I'm just going to go over a couple of them, get you guys familiar with what they look like. And I mentioned this, the reason I'm going over this is I mentioned it in another video about investing. I think there was a comment or two on it about kind of what is a cost curve, like what does it entail? Is it to individual companies? Is it, a group of companies? Is it a sector? What is it? Why is it useful? I'm going to look at uranium, platinum. I think I got oil in there as well. And then I also have like a production profile that I also look at sometimes. So when I look at these things and you're investing, the lowest risk of anywhere you can buy a commodity, basically an asset, especially if it's like the physical metal, is below the high end of the cost curves. What happens is the price bounces between a couple of areas. It goes below the cost curves in a big bear market. Sometimes it goes below the medium cost producers, and that's the lowest risk area to buy a physical metal if it's a commodity. Something like a platinum or silver. And guys, I don't buy physical copper. It takes up way too much room. So I buy platinum, physical platinum, silver, and gold and stuff like that for precious metals for storing wealth. But when you go below the high end of the cost curves and go even below the medium costs in the cost curve, and I'll show you that here, that is the lowest risk spot to buy. And if you've got charts that are backing you as well, technical charts, and they look like they're bottoming and coming back up, I mean, that's to me the lowest risk spot that you can purchase something. It's as sure of a bet as you can get. Nothing's a for sure bet, but it's as sure as you can get, where if you just hold on for a while, it could be 5 years, 6 years, 2 years, whatever the time frame is, more than likely you're going to make a lot of money. But you have to be patient. This isn't trying to make money in a year. This is about making generational wealth. And my mindset, maybe it's just different than other people, is I buy and I hold assets. I'm not trying to get rich in a year. I'm not trying. I mean, if it happens, it happens. But it's my mindset isn't like that. And the mindset where you're trying to get rich in a year, you're going to lose your butt. You're going to lose your butt in something because you're going to get into something that you're chasing price, and it's going to just go in the opposite direction. And if you're doing this type of analysis, this isn't a get-rich-quick scheme. And if you have a good amount of capital to deploy, a good amount, I mean, if you have hundreds of thousands of dollars or tens of thousands or whatever it is, in millions, if you've got millions, you're going to take more of an approach like this than you would trying to jump in and out of something. I don't do the in and out of something on the short term. Mine's always more of a long-term approach. You're going to be invested for probably multi-years, and I'm looking for outsized returns, big returns. I'm not looking for 50% gain. I'm looking for 500% or 1,000 or 2,000, something on the lines of that over the time frame. So what I've got behind me is the cost curves. I got uranium right behind me right now. And let's step through what a cost curve is and why it's useful. So I've got uranium here. This is for 2019. I don't have the most recent one, and it doesn't really matter because the cost curves don't really move that much. And what this is you've got a whole bunch of different producers, developers in this cost curve. And what this is you've got your cost to produce from certain mines. And then it goes all the way up and all the way up. And your highest cost producers are around $80. And remember, these are cost curves. These cost curves move around with inflation. They're not just set in stone. Sometimes they go down from technological improvements. Sometimes they go up from inflation. Now, in 2019, the uranium price, the spot price was $33.30 per pound. It cut off everything above 120 million pounds right here. This is pounds on the bottom. This is your full cost of production of uranium. and it cut everything to the right hand off. So you're cutting about 100 million pounds almost of production at this price. So you're at like 120 or lower. Now, some of these guys, they're not going to produce either because they'll probably feel like they're giving away their uranium when they produce it. And that depends on the company and what they want to do. Now, looking at the cost curve, just to let you know, if $33 were to go to $50, and you're in one of these cost curve producers here that produce between 120 and 140 million pounds, and their cost is like $33. They're not really making any money here. When you go up, the higher cost producers provide more leverage to a price move than the lower cost producers. And the reason that is because when you divide by zero, your earnings per share, you have zero earnings at $33 right here for this person. That's a cost curve right in there. Oops. Right in this area here. And when you go to 50, and let's say they could produce, and they do produce, they went from earning $0 to a lot. And that multiple, you can't divide by zero, but the multiple could be 1,000 times. This person, if they were producing, already made money. So if you go up $10 here, and let's say they were already making $10 or $15, that's really only a double. So a lower cost producer doesn't, generally speaking, doesn't have as much leverage to the price moves in a commodity. And it's tough to value companies at the bottom because usually if you're trying to buy some of these higher leveraged ones, their balance sheets are going to look horrible and they look like they're going to go bankrupt, and they could go bankrupt. But it depends on how long that commodity stays down there and how quick it rebounds. And if you think it's going to be a quick rebound, you can bet some of your money on a high cost producer, and if they have a lot of debt, it goes way down. And you can get a little bit of money. And I'm not speaking in uranium per se. I'm just speaking in general. You can get a high debt, high cost producer or medium cost producer somewhere in this range here, and it goes all the way down. And sometimes they price these things at pennies on the dollar because they think they're going to go bankrupt. And if they don't go bankrupt, and you get a nice good price rally in that commodity, that's when things really work out your way, because you can go up 100-fold in a very short period of time. And I'm literally talking 100 times your money. It's possible. I'm not saying it's going to happen every time, but it's possible. So this is what the cost curve looks like. And the lowest risk time is to buy when it's down below the high cost producers, especially if you're buying the physical metal itself. With mining companies, depending on where they are on the cost curve, there is risks of them having problems, financial problems. But that is the time to buy, is when everyone's panicking and they think they're going to go bankrupt, because that's when they get pushed to levels that you'll never see again. And some do go bankrupt. That's where you get your asymmetric bet. You spread your money out. You do portfolio allocation sizing less than 5% of your portfolio. Because if you lose a position, it's only losing 5% of your portfolio. But if you get a 50 times your money, you turn a 50x could completely turn around a portfolio just absolutely massively with a 2, 3, 4, 5% position in it. That's your asymmetric bet. But this is what the cost curve looks like, and I'll show you another one here. This is the South African Platinum Mines cost curve of 2019. And in 2020, platinum sold off quite dramatically in COVID. It went all the way into the 600s, and this is $600 here. Basically went down to the lowest cost mine that there is in platinum. And I just started laughing because I didn't believe it, and it did it. So I bought as much as I could between $600 and $800 as it came back up in prices. But knowing this cost curve knows that platinum can't stay down there, otherwise no one can produce platinum at a profit. And South African platinum mines is 80% of your production, roughly, of all platinum. So you're looking at this, and it's all the way down at $600 something. That has to go higher. It's a super low risk entry point for platinum, and I'm telling you, I bought as much as I could. And some of the premiums went up, so it was in the 700s. even when the price was in the 600s on some of it. But that's good. I'll take it. Take as much as I can. Now here is global liquids capacity in 2030 by break-even. This was given out. It's not that 2019. Weighted average based on production in 2030. And they're trying to project some of the break-evens of the price per barrel, US dollar price per barrel of Brent crude. And looking at this, if you go on the higher cost producers here, deepwater OPEC, other tight oil, other frontier stuff, oil shale, it's going all the way up here. The break-even point is like $100 for some of this almost. So the price of oil is going to have to go over $100 for us to produce over 110 million barrels per day. And we're at like 85 right now. And it turns on some of this stuff out here, potentially. And we may have to produce this amount, which means the price has to go over that. Now, if we don't bring on production and we don't invest in this, this number goes down, which means it's not 110, it might be 100, it might be 95, because we're not dumping enough money to offset the production losses in all these ones over here, which is a roughly 6%. 6% means you need to add on 6 million barrels per day to offset declines in this production. So, and they've got biofuels and processing gain and other NGL adjustments in here too, to get it all the way up to 15 million barrels, just to let you know. So what I see here is, I think we're going over 100 million barrels soon, and I don't think we've got the oil. I think they are, I think we're going to be in a huge energy crunch. And one thing I want to mention with an energy crunch or an energy crisis is, we had this same setup in the 1970s. Everything's the same. We had an expansion phase of real estate, a larger demographic. We had inflation, and we had an energy crunch crisis. I think it's setting up just like the 70s almost again. That's what I think. Now, I talked about the platinum cost curve up here. Look at the platinum demand over time, and this excludes automotive uses. So this is just industrial uses outside of automotive. And look at how this thing's going on up and up and up and up. We're going to be piercing over 2.5 million ounces per year of industrial demand that has nothing to do with automotive. And this growth is growing at about 5% per year. And so it's growing more rapid recently over time. This is for chemical, electrical, glass, medical, biomedical, petroleum, and other uses, all in here. And there's other stuff that could be coming with fuel cells, and hydrogen fuel cells. And it just dwarfs all of this. In fact, it uses so much platinum that it wants 2 or 3 amounts of platinum in the world that's currently being produced. And I've got that over here. This is the South African platinum output in gradual decline. The peak output was in 2006, and we've been declining ever since. We've been struggling to keep it at a higher level, and this is 80% of production. It's at 3.5 million, 3.75 million in 2020. But let's say we can get about 4 million. Total world production's about, let's say, 6 million ounces. And I just showed you up there, it was about 2.5 million for other industrial uses. And we've got catalytic converters and all these other things that are coming. So platinum right here with this production, peak production in 2006 and declining, one could conclude maybe that we are at peak production. We had very high prices in 2008, and it didn't raise the production level of platinum. And it's declined ever since. So I see that as a huge opportunity, because we could already have hit peak platinum. You buy platinum, you sit in it, and it's the cheapest metal of all the precious metals. Now I put this over here. This is also what I look at as market deficits. I have palladium here. We have a massive palladium deficit, minus 300,000 ounces, 415, and so on. We've been in this big deficit of palladium. When palladium reaches over about 2 times the price of platinum, and right now we are over that, we are going to substitute platinum for palladium. And that's going to drive demand for platinum. And these deficits are going to have to slow down. So they're going to slow these deficits down by putting in platinum. So if you're looking at something and you're going to evaluate like a metal or something like that, what you want to do is you want to look at the cost curve and know your cost curves. You want to look at your market balance. You want to look at deficits and surpluses. And you're looking to invest in things that have deficits or growing deficits. Palladium's deficit is ultimately platinum's deficit too when the price gets to a certain level. And platinum, with the production declining, I think is a great bet. I also think oil's a really good bet. I think uranium's a good bet. Anything I put up here is probably a good one to look into. Silver's also very good. Copper's very good. All these metals and energy, we'll call it energy feedstocks or energy sources, they're going to be incredible over the next 5-10 years. And the expansion phase of real estate is an inflationary driver which rotates money into these things. So not only do we have the supply demand that we're seeing here going to compress the ratio against gold, we're also going to have more investment demand and money flowing to protect itself against inflation running into these assets. So it's going to be amplified quite a bit. And this has always happened in previous bull markets and commodities. So if you guys want to be commodity investors, this is the stuff you got to look at. Production, market balances between supply and demand, and then your cost curves. And if the rare opportunity comes when it sells off below the high cost producers, and sometimes it goes even below the medium cost producers, that's when you get greedy as heck. That's when you can make a lot of money. If you guys like this content, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.